Good afternoon. You're watching the Mutual Fund Corner. I'm Manglam Malu and tell you about the markets before we go ahead and answer all your mutual fund related queries. It's been a rather choppy day. We saw the markets open at around the 20-day moving average. Thereafter, there was a dip. That dip got bought into, and there was supply at higher levels after that dip. And over the last 1 hour, it has been rather range bound, but still holding with a gain of almost 50 points for the Nifty. The similar can be said about the Sensex. The mid-caps, however, are outperforming. So in this choppiness, your best bet for investments usually are mutual funds as well as SIPs. So to help you understand them better, help you make better investment choices, joining us today, we have Santosh Joseph, who's the founder and partner at Germinate Investor Services, and Shweta Rajani, the Senior Vice President and Head for Mutual Funds at Anand Rathi Wealth, joining us now. Thanks a lot, Shweta, as well as Santosh, for joining in and helping all our viewers with their mutual fund related and investment related queries. So let's dive into the queries directly. First up, we have Hari writing to us on Twitter. He wants to know more about flexi cap versus the multi-cap funds category. Ladies first, Shweta, your thoughts on this? Of course, everyone, gets confused between the flexi cap versus the multi-cap category. Which one do you think is better? Flexi cap, like the name suggests, gives more flexibility?
Right. So the difference between the two, firstly, in a flexi cap category, this is a newly created category and this was created in September 2020. Flexi cap is a category where the fund manager has full flexibility to choose his market cap. So if he chooses to have a 0% exposure to small cap companies, he can choose to do that in a flexi cap fund. Versus in a multi-cap fund, the regulation says that you need to have a minimum of 25% allocation each in large cap, in 25% in mid cap, and 25% in small cap. So from this standpoint, flexi cap as a category has more leeway to the fund manager, and therefore his potential to do his market cap changes, his sectoral changes is far higher. So therefore, a flexi cap fund would have an advantage over a multi-cap fund.
So once the flexi cap has an advantage, or once the advantage is established, what is then the need for multi-cap funds? Is there any advantage in the multi-cap funds as against flexi cap as well?
So the advantage of a multi-cap is that extra 25% allocation that you would get to small caps. So if somebody wants to take a small cap exposure but wants to limit his risk and therefore not go for a complete small cap fund, then he has an advantage by investing in a multi-cap fund.
All right, fair point. Thanks a lot for that, Shweta. Next question comes in again from Twitter. Varun Anil writes to us. He wants to know if multi-asset allocation fund will be better than balanced, advantaged, and other hybrid funds. Shweta, since you spoke about flexi cap versus mid caps and multi caps, this question again is specific to the kind of funds that would be better. Your thoughts?
Right. So first let's understand what is the difference between a multi-asset and advantage or the hybrid funds that we have. In a multi-asset fund, as per the regulation, a minimum 10% would get invested each in equity, 10% in debt, and 10% in gold minimum. In a balanced advantage fund, the fund manager has a choice to invest in equity or debt, or even take exposure to derivatives if he feels the need. But there is dynamism here. So there's no minimum requirement of how much should be in equity or debt. Compared to that, there are other hybrid categories like aggressive hybrid, where the fund needs to have a minimum 65% equity. And then there is conservative hybrid, where the fund manager needs to have a minimum of 80% in debt. So in the hybrid category, you basically have these four options. If you see the last 1 year performance of a multi-asset fund would have delivered as a category around 13.5% return. Versus the balance delivering around a 10.5% return. And this has mainly happened because of the gold exposure that multi-asset funds would have, and that for a certain period in 2020 did perform well. But if you see the 5-year performance of a balance advantage category or a multi-asset category, they are very similar and they would have given around a 9.5% return. That's because mainly over a longer time period, your gold returns are very similar to your debt returns. Now, if you will observe in each of these are basically asset allocation funds. And asset allocation is a very important decision when it comes to money management. But this decision should ideally not be left to a fund manager. And in my opinion, what asset allocation suits you the best, it would depend on what your investment horizon is, what your return objective is, and what your risk appetite is. So you may choose to have a 50-50% of equity debt or a 60-40 equity debt, and the fund manager may be running a different objective. So therefore, if you ask between multi-asset and balance advantage, what is better? A balance advantage would be a better option because of the dynamism available. Even better method would be that you separate, once you've decided your asset allocation, you separately invest in a pure equity fund or a pure debt fund.
All right, fair point. Well explained out there, Shweta. Meanwhile, just keep an eye out in the market. We're seeing, the Nifty bank slip a tad bit, and as a result of which, we have the Nifty, which has taken a bit of a knock from the top as well. The Nifty bank is actually now down by almost 0.5%. And it's been led lower by a couple of these private sector banks. So we have Kotak Mahindra Bank, which is down almost 4%. And alongside that, even Axis Bank is languishing around the lows of today's trading session. But what's doing well is the mid-cap space, nearly 1% on that index. And that's led higher by a lot of stocks. We have Jubilant FoodWorks, which has moved to the high point of trade. In fact, it's a record high for that stock. And a couple of other stocks which are doing well as well from the broader markets. We have Raymond. That stock's really taken off this month, up almost 23%. And just as we speak, the intraday chart of Raymond comes up for you on your screen, up almost 7%, hitting highs of the day. Next one's for Shweta, where Milan Chai writes to us on Twitter. Milan wants to know, how long should one stick to a fund? There are blockbuster funds of the past who are not even top 10 in their category right now. Although mutual funds are for the long term, is it better to stick to one mutual fund, or should one shift to better funds within the same category? Valid question here, Shweta. Everyone keeps talking about the long term, but again, no one talks about shifting, churning. And the point that he made, the funds that did well in the last 10 years, not necessarily are going to be the one who will do well in the next 10 years.
Right. I think some of the things very valid and put out nicely, that when you're looking at equity investments, you need to consider a long-term horizon. But that doesn't mean that you don't monitor your funds. So the first step towards this actually starts with when you are doing your fund selection, or when you're taking your decision to invest in a particular fund. And at that stage, rather than just looking at a past performance or a past return of a fund and investing into a fund, rather than that, what one should look at is consistency in a fund's performance. Look at how the risk management has been done. So what is the risk to reward ratio? What's the risk efficiency of a particular fund? One should evaluate how the fund has performed specifically in volatile markets or falling market conditions. Also look at the, try and get a futuristic view on the fund of what is the potential going forward basis the current portfolio construct. What is the track record of the fund manager? So at first step itself, if you look at this, rather than just looking at the past return, the chances of you having an underperformer in your portfolio would ideally reduce. And post that also, you should quarterly track your funds and see how have they been performing. Certain signs where you should get a little cautious is if you see on a 3-month basis your fund is underperforming the benchmark, or it is falling in terms of its rank compared to other funds in the category, then that will be one trigger point. If this continues for, let's say, a period of 6 months where you're seeing the fund underperforming the benchmark as well as deteriorating in its rank compared to the peer category, is where you should take a call on whether you should switch out from the fund or no. Few other points that you can check during this time period of the fund's deterioration and performance is what is the kind of changes the fund manager is making to its portfolio. Are there any negative news around an AMC or news of a fund manager exit that's impacting the portfolio performance. And ideally, a period of 3 months to 6 months is where you should hold on to an underperformer, post which you should take a call to switch out.
Fair point there. Monitoring your performance, your fund manager's performance is key to holding in investment for the long term. Like Shweta said, more important is not to see whether the fund has outperformed during the up cycle, but whether it has actually fallen less during a down cycle or not. But that will tell you whether there has been some outperformance versus the benchmark or not. If that doesn't happen for 6 months, then perhaps you're better off looking at other options or speaking to your financial advisor. We'll thank both Shweta as well as Santosh for stopping by, helping all our viewers with their mutual fund related queries and helping the investor community get better at planning their wealth better and making more money as well. With that, we're out of time on this edition of the Mutual Fund Corner or MF Corner, but do remember to email us or write to us on Twitter with all your queries. We'll address them with our experts every Tuesday and Thursday.